Welcome to the Rigatoni Capital podcast. I am your host, Colin. It is the morning of April 2nd, pre-market. Stocks have been selling off overnight due to Trump's podium speech last night. And oil jumped immediately after he said that he vows to hit Iran extremely hard. And the war should last another 2 to 3 weeks. And folks got, antsy overseas and they sold in a panic. Does that make sense to you? Well, we'll get into that. What I wanted to say was the most important news of the day is that it's kind of chilly, like 50 degrees, a little rainy, doomy and gloomy, completely opposite from yesterday, which was 77 and warm and sunny on Wall Street. So today, it's very depressing, doomy and gloomy. And that's why the stock market is really selling off, just so you know. So, yeah, what do you guys want to talk about today? I just don't have much to say because I think we're winding down the end of this week. I think investors are exhausted, especially probably folks that are in the industry. They're probably tired. And, I think that we had this dip. I told you I didn't buy the dip. And, Tuesday, Wednesday, we had this rally. But really, the big rally was on Tuesday, wasn't it? And then Wednesday, we kind of had a strong rally. And then it kind of like started to sell off later in the day. I mean, the S&P was only up 0.75% yesterday. And I'm saying only that wasn't a big day compared to the huge day it had on Tuesday, the relief rally. And then today, we've wiped out more than that in terms of pre-market sell-off here. We're down 1.5% on the S&P pre-market, and that's Thursday. And remember, the market's closed tomorrow. We do get jobs data tomorrow, but the market is closed tomorrow. So who wants to hold, if you're a trader, do you really want to hold stocks for the next three? If you're a long trader, do you really want to hold stocks for the next 3 days? Especially if we're going to have some kind of invasion that goes wrong. Now, we don't think I don't know if there's going to be boots on the ground per se, but, I think that there's two special ops situations that I'm assuming might happen. And I guess it could be Carg Island. I'm a little unsure about that one. But there's that bigger island. I'm not this Iran war expert, and I don't claim to be, but there is that larger island that's kind of closer to the actual, what would you call it? The Strait of Hormuz, like in the center of it. Carg Island, I believe, is a little more, what is it? A little more west or north. And there's this bigger island that may be more valuable in terms of whatever the U.S. is trying to accomplish. And don't ask me what they're trying to accomplish. I have no idea. And, Trump did this speech at 9 p.m. What a waste of time. Now, I can tell you that I do prefer a president that gets in front of a podium and just talks to you, even if he doesn't have anything to say. There were a lot of times when Biden was the president, and I had wished he communicated more in that setting where he gets on a podium or he sits in the Oval Office and he addresses the nation. So, like, Biden never did that. And if he did, I mean, yeah, he didn't make any sense. Now, Trump doesn't make any sense either. I don't know who wrote that speech last night. It wasn't really a good speech. It wasn't what people wanted. But war is no joking matter. But in that situation, I mean, I didn't listen to a word he said other than anything that struck me as funny. And then I sent GIFs and memes to my friends during the entire speech because this whole situation has become a laughing matter. I'm not saying that Trump is a joke. I'm just saying that the whole situation where we're in this war to begin with, and I mean, come on. Do you guys are you I like I said yesterday, I know a lot of people that are very concerned that Iran was going to get a nuclear weapon, but I'm not I guess I just don't believe in that, or that wasn't a concern for me. So anyway, look, we're not going to talk politics. WTI now spiking even harder, up 12.2% to 112. I mean, today's going to be an ugly day, probably. I don't think it's going to be one of those days where, retail steps in and buys the dip, before a 3-day weekend. I'm not sure. Bitcoin is at 66. I think that's fine. Gold has pulled back to 4,600. I don't know what the 10-year will do until it opens up. I guess the market, I'm not sure there. And NASDAQ 100 getting slammed almost down 2% pre-market. So, I feel a little bit better because I've been telling you guys I didn't buy the dip and how I was kind of like looking a little dumb there because we had that strong rally Tuesday and Wednesday. Google 289 pre-market. Would you have bought Google at 272 if you thought you could have bought it then 2 days ago? That was on Monday. Google was trading at $272 a share. Now, I don't think it technically kissed its 200-day moving average, as you can see here. The 200-day would have been at like 263. But yeah, I mean, I expected a lot of retail investors to go in and buy Google. And I look at the ITA. I told you I was interested in the ITA the day it kissed the 200-day, and look, I missed it. Not like I needed to buy it. I already own all the defense manufacturers. I already own the NASDAQ 100. I already own all these stocks. But, I was very intrigued to buy the dip. I just didn't. I mean, look at Goldman Sachs. What an incredible buying the dip opportunity on that 200-day, where it hit the 200-day back in mid-March. And then remember, Goldman Sachs, is probably the largest holding in the Dow Jones, I would guess. It's got to be one of the largest holdings. But Goldman Sachs was literally trading at like $785 per share, let's say, in mid-March. It's now trading at $840 a share. Pretty crazy. And, these IPOs sound like they're going to happen. I think the IPOs are going to happen. Now, the problem is that when these companies do IPO, I think they will have their IPO moment and sell off a ton, weeks after the IPO happens, and retail that chases the first day buying the IPO, and there's going to be all this hoopla and excitement around like SpaceX and whatever other stocks that come out, IPOs that come out this year. But look, the house makes all the money. You know who the house is? It's Goldman Sachs, right? And of course, the people that own the private equity before it goes public, because they want to get their money the hell out, man. It has been a scary year for them. Scary last 12 months for them. TransDigm continues to look like crap. Man, Palantir was trading at 126. It's all the way at 142. That's kind of crazy, huh? It was trading at 142 back in late February, mid-February. But really, after that Venezuela Maduro capture, Palantir has never looked back. It's been a strong stock compared to most of the tech world. Berkshire Hathaway is interesting here because I see, we're trying. It looks like we're hitting like some 1-year lows. Surprised about that a little bit. I'm not surprised about it. We look at Berkshire Hathaway on the show and on my Substack all the time. American Express is now trading at 296. I liked it a lot better at 290. So I wrote a post last night on kind of like what we talk about here in the podcast. I think some of it is redundant. Some of it's not, because I get to really take my time and write through the ideas I have. And that post was Why I Didn't Buy the Dip by Rigatoni Capital on Substack. It's a free newsletter. It's a free newsletter. Everything I do is free. It's not, I don't have ad sponsors. I don't charge behind a paywall. Not like there's anything wrong with that. Maybe one day I will do that. But right now, and for a while, I haven't done that. It's just something I enjoy doing, and I feel like I feel like the community on Substack is awesome, and I want everybody to be able to read what I'm thinking. You know what I mean? But no offense to people that actually do charge, because people want to pay for your writing, and I think that's cool too. So I think that it would be funny that I explained to you why I didn't buy the dip in my post that came out this morning on April 2nd. And what if I bought the dip today? That would be funny. Would anybody even care? I could just not even say I bought the dip. But I am interested in American Express. I need to 9:30 a.m. If I have an opportunity, and remember, I don't always have an opportunity because this isn't my full-time job. But at 9:30, if I have a chance to sneak into my brokerage account, I'll look into maybe buying American Express today, and that would be Thursday. And that's pretty crazy because I just wrote why I didn't buy the dip, and I gave you pretty much a bear case on why I'm concerned about the market and why I think that a 10% pullback in the market didn't present any stocks that were trading at attractive prices other than American Express. Maybe you could argue Google, ITA. There are a few names. And then, you'll watch every other show on YouTube, finance show, investing show, or you'll watch mainstream media. And everybody is telling you that Nvidia, Meta, Amazon, I'm probably missing, maybe Microsoft, I'm probably missing a few there, that they're all trading at attractive valuations, those type of companies. Netflix is another good one. They're trading at attractive valuations, and they think that they're long-term buy and holds. I don't disagree with that, actually. I think that is true, that if you didn't have a position in Netflix, or if you don't have a position in Amazon, and you're kind of looking to enter today and start a new long-term investment in one of those companies, I do think those companies are a good bet for you. But for me personally, I already own all of those companies. So for me to like add, and in Nvidia, I'll give you an example, and I always do. I'm up 4,000% on that stock. I'm probably only up 3,700% on that stock today. It's 16% of my holdings. It's my largest holding. And, if anything, I should be looking to trim it. I shouldn't be adding more. But I definitely wouldn't like add more, is what I'm trying to say. This comes down to your own personal portfolio. And remember, your own personal stock portfolio is like your own personal artwork. It's custom. There's nothing like it. It's something that you built and you envision for years and years and years, and you want to kind of create like this masterpiece. And in my mind, I envision having something like Nvidia forever that is a huge big position of mine, and it's a huge winner, and it has created most of my gains. But then in my top 10 holdings, I have a waste management, I have something like Chubb Insurance or Berkshire Hathaway. Like, I have those type of more or less growthy type of names, or a Caterpillar or something like that. And then I also have Bitcoin and Nvidia and Amazon. That's how I envision what I want my portfolio to look like, at least in the future, and how to get to that. So someone like me, I'm not going to add more Nvidia because I already have a lot of Nvidia, and I'm happy with my position there. But if I were a younger, new investor, and I was starting out building a portfolio, and I would not disagree that Nvidia is not a good buy. I think it is a good buy today. I just think that it depends on your situation. and know what you're buying. Of course, why are you going to buy a $4.5 trillion market cap company if you don't know what the heck it is and understand that? Do you know that if you're buying Nvidia today, that and you're a long-term investor, do you understand that only 100% gain gets you to $10 trillion? You know what I mean? So like, make sure, I guess a lot of people don't think that through, but I think everybody that is on Substack understands that. I think most people that would listen to this podcast understand that. I just want to tell you that the 5 headwinds that seem to be converging, I do think that headwinds that we all have are converging, but I didn't really explain to you why they're converging. So that was kind of stupid to say that, huh? But AI disruption, fear, and the white collar recession. I say the market is still pricing in white collar anxiety around AI driven job displacement. That's true, but I think the market is actually pricing in the fact that we are having white collar job cuts already. We know Block, Oracle, these other companies. I can't think of the names, but this is actually happening already, and there is no growth. And in fact, there are freezes on hiring. They're not going to hire more engineers, software folks. Definitely not coders. There's no reason to ever hire a coder again. Now, you can hire someone to code, but they are going to know how to code using AI or agentic AI. There's definitely a use for that type of person that says, hey, like, I'm going to have AI agents working under me, but you need me to run the show here. So hire me so I can make sure that all my AI agents are up and running autonomously and everything like that. So that there is a certain use case for somebody in the tech world that is an expert on AI, let's say. And that reminds me, someone that works at Palo Alto, and I think it's now public information, everything they code, 95% of what they code is written by AI. And it's been like that for like a year or two now. So it's not new news. I talk about how crazy it is that Claude, Perplexity, and OpenClaw seem to impress us every day. Now, are they perfect? No. Are they going to take your job? No. But it is really cool to see what they do. It is actually, now we're almost spoiled because we see the little small mistakes they're making. But if you would have seen this technology 3 years ago, your mind would have been blown and you would have been concerned about your white collar job potentially. Then I talk about why something like financials, this trickles down. If you're going to see job cuts, that means less SaaS seat-based licenses, of course. So it hurts software companies like SaaS companies, but it also hurts the broader economy, like an American Express. And, American Express is notorious for having these business credit cards where, that's how you get points to travel and sit in those business lounges at the airports and everything like that. So the business accounts, it trickles down to everything from American Express. And then, of course, it trickles down to private equity and, these software companies. I always use Harvey as the best example I can think of that had a AI LLM lawyer type of application where I'm sure it's a great program, but why can't Claude do that? And you see something like Claude that can just replicate what something like Harvey AI is doing and do it the same or better. And that's why a lot of these software SaaS type of companies that were private are in big trouble, and those private investors can't get out of it's not liquid enough. They can't just exit, right? I really don't follow the private credit bubble crap and the BDCs. I just don't have any interest in it because I'm a public stock trader, not trader, investor. So I'm in public stocks. I'm in the public market. But I definitely actually think that someone like BlackRock, the stock BlackRock, which doesn't really have a lot of exposure to this, they do, but not as much as like some of these BDCs or even Blackstone. But BlackRock, I think, is like a buy here. And we had Satishan come on, who's in the UK, who writes on Substack, and he explains how he thought BlackRock was very attractive to him, almost as if it's a proxy to the stock market, which it is, but it does even better than the stock market. And if the stock market comes down like the S&P, it does do worse. So there's like a premium there, but BlackRock definitely is a company I own, a stock I own too. So look, that's another example. If I were, again, building my portfolio up, and I try to explain this in the post, like I'm now 42 years old. I got gray hair now. I'm balding. I'm always injured. Yeah, I would be if I were in like my late 20s or early 30s, or let's say I was handling a custodian account for my niece or something like that. Yeah, I would be buying BlackRock here. Why not? Why not? I think BlackRock will be trading higher than it is today in the next 3 to 5 years. So yeah, and BlackRock's a great business, and it's kind of scary how they have their wings everywhere in the world, and they seem to have a lot of power because they own all those proxy votes. But yeah, I think BlackRock is a long-term buy and hold type of company. What else was I going to tell you guys? Oh yeah, so let's go back. So the 5 headwinds that seem to be converging, and these are the reasons why I didn't buy the dip. These are what is scaring me. It's Microsoft, we talk about it every single day. I'm not going to talk about it now, but I wouldn't be buying Microsoft because I'm concerned about Microsoft. I think they're diversified enough that they're going to be fine. But for me, why would I need to own Microsoft right now? An old SaaS company that seems to look outdated in the age of AI and Claude and Perplexity. Why would I need Microsoft again? And other than Azure is growing, and that's, I think, the only reason to buy Microsoft. But it's not the only way they make money. It's not just Azure. It's from their Microsoft 365 application. The Iran war and input cost inflation. I should have wrote diesel in here. I forgot to mention about diesel and how that's such a big macro thing. But this is macro, and this will eventually get itself resolved. Although I think that, for example, the reason the stock market is selling off this morning is because of Trump's podium speech last night that makes it seem like he's gaslighting us, or let's just not him himself. Let's just call it politicians around the world are gaslighting us to think that this war is going to go another 2 or 3 weeks and that's it. It's almost like they can't get out now. Why did they go in the first place? And they're going to try to tell you it's because of uranium enrichment and trying to make sure that they push them back another decade. I mean, it does feel like they're gaslighting us in terms of that. I know there's a big segment of the country that disagrees and think that and likes that Iran is not able to get a nuclear weapon. Maybe 2 things are true. Maybe they went in there to make sure that they have more leverage when they talk to China in a month, because now this is a problem for China to obviously run their economy if they can't get most of their Brent crude or their oil or their gas from this area. So I think that, that's what someone like the Trump administration was looking at. They see the positives and the advantages and the disadvantages, and definitely there are advantages that are just not about making Iran stop building a nuclear weapon or whatever. There are other reasons to also go in there and mess things up. Okay. A contradictory Federal Reserve that's in a lose-lose situation. Really, I don't want to get into the debate on why I think that you should cut rates here, you should hold rates, or you should even increase rates. That's not the debate I want to have today. The debate I want to have is more just like the uncertainty of a new Federal Reserve chair, which is Warsh coming in. And I think that the markets didn't like that pick. It's obvious that they didn't like the pick of Kevin Warsh because he is less interested in trying to expand the balance sheet. I guess he's not into QE, but he said he would be into QE when only it's a very, very bad crisis, and then you have to stop. So I think that's how I understood it, is that during COVID, he was for QE, but why did we continue to do QE like years later? And he thinks that's what caused the issue. My whole point is like, that actually just doesn't matter either, what the market thinks, that what the Fed chair himself actually believes in, because remember, there's a board and every vote counts really. And especially him coming in there is kind of like a rookie pitcher, and markets are going to test him. Even the Fed chair board, it might be hard. I'm sorry, even the elected board members, it's going to be hard to persuade them to do what he wants to do. His philosophy is kind of wacky. It's like dovish on rates, but it's kind of like hawkish on the Fed balance sheet. I think that this is going to be a headwind going into later this year. I also think that the Federal Reserve, regardless, is in this lose-lose situation. They think they have this dual mandate, which is 2% inflation, but making sure that jobs are okay, the job market's okay. But really, of course, they have by the time we're talking in, I don't know when, 6 months, we're going to have $40 trillion debt here in the US. And ultimately, if you're not able to get interest rates down, and I'll call that the short-term and long-term, short-term, the short end of the yield curve, the long end of the yield curve, eventually they have to do some kind of bond repurchasing. And I believe that we are doing that now. It's just not large chunks like we were doing back in probably 2020, 2021, right? It's not like that and crazy. We're only buying the short end of the yield curve, but it is a form of QE. Like, your money is being diluted. I hope you understand that. The cash you use, when people say cash is king, oh, cash isn't king unless you're Berkshire Hathaway and you have so much of it that you can hold off until there's a buying opportunity. There is value in that. But for someone like you and I, who don't own as many assets as Berkshire Hathaway, we kind of want to make sure we can save enough cash that we can own assets with that cash. You don't want to sit in cash. Okay, you want to understand that we have a goal of 2% inflation every year, and even Warren Buffett said on Becky Quick's interview 2 days ago is that he wishes the inflation target was 0%, because 2% per year as a target. Think how messed up that is. Do you know how much that compounds over time? Just 2% per year? A lot is what his point is. And that's going to bring me into maybe a few other subjects here. Look at what Ryan Dietrich said. Sorry if I'm talking too close to the mic. Ryan Dietrich said, "I'll believe this rally when we are higher on a Thursday." So this is so good. He said this yesterday, and I told you I wasn't buying this 10% correction dip. And then Tuesday, Wednesday, we had this rally, and then Ryan said, I'll believe this rally when we are higher on a Thursday. If lower tomorrow, that'll be a record 10 in a row lower for Thursday. What did I tell you? That there is this idea of a 3-day rule. There's this idea of a 3-day rule. You got to be patient. Just because you hit a 10% correction, give it 3 days and see where we're at. I'm sorry, I'm jumping all over the place. I just remembered I'm not done my 5 reasons, but are you guys getting bored about this? My 5 headwinds: AI disruption fear, the Iran war, a contradictory Federal Reserve that's in a lose-lose situation. I talk about the US-China Cold War needs a handshake. I'm not going to talk about that because it's not that big of a deal. It's just, I think that it is a headwind, the Cold War with these two at this point. They need to meet again and see what happens. But of course, the market's not going to wait for all these things to happen. I'm just telling you, these are the reasons why I didn't need to buy a 10% correction. Hyperscaler CapEx spend. I told you this is the least of my worries. This is the Michael Burry thesis, is that these guys, these hyperscalers, it's really only 5 of them. Okay, you can include Meta, Oracle, Microsoft, and Amazon. Maybe there's only 4. I'm missing one. Google. So there's 5. The big 5 hyperscalers. Some of them are going to be okay, and some of them I kind of agree that they're going a little overboard here. And it's not just take the word AI. Just think of it as heavy, light asset company now trying to be a heavy asset data center, kind of like a infrastructure, literally a physical data center. So, and then pretty much that's all I wanted to talk about here. Let's go back to Ryan Dietrich, 3-day rule. Sometimes I say, think about as if you lived on an island, and that was in the Jesse Livermore book, reminiscent of a stock trader. Is that what the book's called? And that's where I thought I found this investing idea, and I could read that book over and over again, and I can't find that particular section of the book. It's a particular chapter. It's Jesse Livermore's friend that moves to the Bahamas, and he's a successful trader, and he ends up thinking that he's become a really good trader because he lives on this island that doesn't have internet access. So the newspaper he's reading is from yesterday's news. So he's not reading today's news, and that one extra day causes him to make less mistakes or less rash decisions in his trading. And I think the same can go for long-term Rigatoni Capital type of investing, is that just give it a 3-day rule, but you can't give it a 3-day rule. And that's what I talked about in my post too, is because let's say you're down 10% and you get this whoosh mid-market day where it looks like stocks are collapsing incredibly, and the New York Stock Exchange might halt. What's going on? Those are also really good times to step in and buy, because usually that is signaling to me that we're getting into some kind of bottom. But of course, I also recommend dollar cost averaging. So a professional buy the dipper doesn't dollar cost average. We are looking for stocks that are trading at attractive prices. And we're also not trying to time the bottom either. We're just trying to buy stocks when they look cheap. Does that make sense, guys? I hope so. Goldman's top traders discuss key ideas and sector standouts. The only reason I pulled this up is because I saw this Goldman Sachs trading and sector specialist sector sentiment trends, March 2026. It goes over tech, financials, healthcare. It goes through all the sectors, and it gives you these type of trends. So it sees a downtrend in the sector. So let's use tech as an example. Tech has semis, software, internet, hardware, telco, cable, and media. So it's showing you its thoughts. It says semis, there's a downtrend. Software, there's a downtrend. Sentiment, downtrend. internet sentiment downtrend, hardware flat, telco cable flat, media flat. We'll use something like energy as an example. No, let's not use energy. Let's use consumer as an example. Retail sentiment is up, but restaurants sentiment is down. Gaming and lodging and leisure is up, but staples are flat. What I'm trying to tell you is that as a long-term investor, this means nothing. This means nothing. Because remember, I'm noticing it's saying Goldman Sachs trading and sector specialist sector sentiment trends. But this means nothing. This means nothing. Of course, it means nothing. But yeah, I mean, who cares if sentiment trends going down? I would buy sentiment trends going down. So anyway, that's the only reason I brought this up. I saw this. I'm like, oh, this actually does not make a difference for someone like us, huh? OpenAI is now valued at $852 billion. That's about 5 Disneys. And I keep seeing this photo everywhere that shows you OpenAI's large valuation and then all the companies that would go inside of an $850 billion valuation, like McDonald's, Disney, Boeing, Uber, Comcast, and Ford. But why am I bringing this up? Because I think OpenAI shouldn't be valued at $852 billion. I think that if it were to IPO, it's going to have its IPO moment, and anyone buying the IPO are going to get hit hard. I think that's a headwind. I should have added that, is that I think that something like OpenAI is valued way too much, I think. And I mean, maybe OpenAI can eventually grow into a high valuation like this. But this is, to me, speculative. This is really speculative stuff, and I thought we're not doing speculative stuff anymore. I thought public investors want Halo. Why do they want OpenAI? Madness at the grocery store. I talked about this yesterday, that at the grocery store, since the year 2019, that's 7 years ago, a cumulative inflation is 47%. So let's say you were shopping in 2019 and then you shop today. Your groceries on average, it's a broad average, are up 50% since 2019. That means that most of the stuff you're buying is over 50% easily. The 50% is just an average. So why did I pull this up? I don't know, but look, I'm pretty, it says, regardless, I can hardly go to the grocery store these days without a sense of shock at how much I'm spending, even while buying as little as possible. Money savings tactics, choosing cheaper venues, substituting products, just eating less don't seem to work anymore. This guy looks like me. He's got the same haircut, and he's got my wrinkles, and he's got my gray beard. Now, I don't wear this type of clothes. I wear a hoodie, but I do go grocery shopping every day. I go to a grocery store every single day because I don't like to shop. I just like to go in and out and get what I want for that day. And of course, it's crazy expensive. Of course, it's crazy expensive. But that's why I buy Bitcoin. That's why I store my wealth in Bitcoin. You know, Bitcoin is super volatile. That's the negative to it, because it's not for everybody. Nobody can be in a volatile asset like that. But it technically does protect your purchasing power if you owned it since 2019. So that's about it, guys. You know, I'm not going to come on here until Monday morning. I wanted to just say, yeah, I'm going to feel a little bit bad here if I do buy stocks, because I just wrote this post on Substack on why I'm not buying the dip. So I don't know. I'm just unsure. Like I said, at 9:30 a.m., I'll open up my brokerage account and just see if there's anything Another thing I might do is just buy more NASDAQ 100, because the NASDAQ 100 has all of these stocks in it. Other than Microsoft, I don't want exposure to. I'm a little bearish on Microsoft, but that doesn't mean anything. Microsoft, usually when I'm bearish on a stock, it does well right afterwards. So don't take my advice on that. But I don't see any value right now in something like Microsoft. I would like to see it pull back more. Let's check it out. So when looking at Microsoft, and if you're interested in buying something like Microsoft, you have to really revisit the investing thesis on Microsoft, knowing that Claude and Perplexity and these type of AI stocks exist. Because Copilot, in my opinion, doesn't seem to work well for me. It's not doing the job I want it to do. Maybe I am using it incorrectly. That is quite possible. So I would do research on that. I would do research on what are these really, is the Microsoft 365 business really valuable anymore? I'm just talking about Excel spreadsheet and Outlook and Microsoft Word. Has something, can somebody use something that is similar to those products today? Now, these businesses, even like my small business, is locked into the old Microsoft 365, I'm going to call it, and we use their cloud service and everything like that. But that is not why you own Microsoft, because that's only half of its business. The other half of its business is probably Azure, or at least that's, a high margin. I mean, should we just look it up? Should we just look it up? Okay, so this page is from fiscal.ai under segments, and it shows you a few different segment and KPIs section. It splits the business up into a few different ways, but I would assume that this is the one you want to look at that really kind of goes over segments like LinkedIn, gaming revenue. This is this is better. This is probably what you want. And it obviously goes back to June 2016, because I'm not sure why it does that. So, and one thing I would do probably in this situation, I would just take a snapshot of this photo and I would plug it into Claude, and I would ask Claude to specifically describe each segment, because I'm not an expert on anything. I don't know. I know a little bit about everything, but I don't know a lot about one particular thing, like Microsoft's business. So I see Microsoft 365 commercial products and cloud services revenue. I want to know where the Azure business is versus something like what my business has. We don't have Azure, but we use their SharePoint cloud, and then we also use Excel spreadsheet, all the basic apps. So I would like to know where that is versus Azure, because I think Azure is definitely valuable. And if the company was only Azure, like only a cloud provider, I would be interested in it. I do like the fact that they have the gaming revenue, the LinkedIn revenue, and they probably have a lot of different types of, like, they have some search and new advertising revenue. What's that, Bing or whatever they own. And I do like that the company's diversified and it's almost like a holding company. But at the same time, I don't need to own Microsoft unless I'm missing part of the story. So thank you guys for watching, listening. Check me out on Spotify as well as YouTube. Also, I am on Substack under Rigatoni Capital. And like I said, this is all free. My Substack's free. I don't charge anybody for it. I don't do advertising, sponsors, of course, because nobody's watching this yet. And I don't know if I would ever want to do that. This isn't my full-time job. I just like talking about the stock market. Now, I will have 2 guests come on the show next week that are really, really fan favorites. What happened was I used to post I used to post these podcasts with guests on Substack, and then I eventually put them on YouTube, and now I put them on Spotify, and now I just do my own show in the morning. But they'll come on next week, and I'll interview them and stuff, and we'll go over. They're Substack writers, and they're really good investors, and they have experience in investing on Wall Street, and good stuff. And looking forward to it. Guys, have a great Easter, Good Friday, and enjoy the 3-day weekend. I will miss you guys. Thank you. Take care.